Jack Bogle came up with the old school 3-fund portfolio 40 years ago, but I updated and enhanced his strategy for now in 2025. I'm going to give you not only the best investing strategy on the planet, but also give you the ultimate portfolio allocation based on your age and life stage so you can do this all by yourself and get very rich without paying fees. Your 401k is likely still following that old school method, which worked 40 or 50 years ago, but things have definitely changed. I'm an actual university professor, and my academic background has led me to this research, which I'm going to share with you. In this video, I'm going to quickly go over the Jack Bogle strategy that was great and still has pieces of greatness in it. We just need to update the actual funds that go in the strategy because the old funds just don't work nowadays. Things have changed substantially in 40 or 50 years, so your portfolio needs to get updated to the times. So I'll fill you in with the actual ETFs that work for 2025. I'll also explain how I'd set up the actual percentage allocation in one's 20s, 30s, 40s, 50s, 60s, and above with actual data. I'm going to prove my points and show how one could gain much better returns while actually staying much more safe with the new 3-fund portfolio. I also made a video on this topic a year or two ago, so this is the updated version for 2025 with some important updates and some important changes. This is one of these videos that you're going to want to pay full attention to, and you're going to want to sit back and actually watch because it is a bit longer, and also this is going to be packed full of information, things that you're going to want to go back to and actually re-watch to figure out how it fits for you personally. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. Now, back in the day, Jack Bogle came up with this idea where if one wants to be completely invested perfectly, that they need to be diversified as much as possible. You've probably heard all your life that one needs some stocks and some bonds, but if you've looked at your portfolio at all, you're probably asking yourself, why am I in these bonds? These things don't move at all. Now, Bogle said that this is a way to protect yourself in case of a market downturn. If the stock market drops, then your bond should keep at least a portion of your portfolio safe. So if you're following this method of like half bonds and half stocks, this is a fine way to invest unless you want to actually make some money. I've used this analogy a bunch in my classes, but this is basically like saying most of the time the temperature outside will be sunny and hot, but 5 or 6 days out of the entire year, it's going to be very cold. So since it might get cold at some point, just wear a big heavy jacket every single day just in case so you're prepared for the cold. Market cycles are a normal thing. And if you've been investing for any period of time, you know that we usually have 8 to 10 good years followed by 1 to 2 bad years where the market has a correction or reset, then goes right back to a good decade or so. Why would it be logical to set up your portfolio so much so that you're very much protecting yourself for that 1 year of bad, but then missing out on 10 years of very good? Now, if you're very well established and have a lot of capital and your money's already grown to the size that you'd like it to grow to, or if you're in retirement and you no longer have an income coming in, then it's going to be smart to hold some of that money outside of the stock market and make sure you're safe in that way. And I'll get to that, but for the vast majority of us, we're still in build mode. You'll hear people like Dave Ramsey and Ray Dalio tell people to be very diversified and set themselves up for a market crash. But that's because they have a different perspective. When you have tens or hundreds of millions of dollars, your priority shifts from growing the wealth to wealth preservation. So if you're not there yet, then you need a different approach. The crazy thing though, is that if these very rich people were investing in my new 3-fund portfolio, they'd be even richer today. To understand how to optimize your portfolio correctly, you do need to understand the old school 3 portfolio method, and then I'm going to show you how my new 3-fund portfolio uses the correct funds to actually get you to where you're trying to get to. So the old 3-fund portfolio is basically a portion in US stocks, then a portion into international stocks, and then a portion into bonds. The whole point was to diversify so that there's different parts of the market and different things outside of the market. In case one part of the stock market were to drop, the other two should help keep your portfolio up, and so you should always at least gain a bit. By holding some bonds, if the stock market were to crash, then at least a portion of the portfolio would at least be safe and stabilized. And this worked very well until it stopped working. In 2022, the S&P 500 dropped a solid amount. It dropped about 18%, which is not fun at all. But let's look at how the bond market hedged against that big drop. It should have at least held it steady. Wait, what? It dropped like a rock. Look at this for the year of 2022. And just look at this 5-year chart overall. The biggest bond ETF was worth around $90 in 2020, and now in 2025 it's down close to $70. And that's supposed to be the safest, sustainable part of the portfolio? Bonds had traditionally been a very safe portion of the portfolio and something smart to hold at least a portion of, especially through things like recessions and the dot-com bubble. But nowadays, things have changed. So in the old 3-fund portfolio, the bonds were supposed to be the safe section. The US stocks were supposed to be the foundational portion, where one could expect to receive the market average, like 8 to 10% appreciation per year. And then the final section of the portfolio is supposed to be the highest risk, but also bring the highest reward. This was international stocks, and since the rest of the world outside of the United States is such a big place, and we want to be able to get some market share from somewhere outside the United States, this made a lot of sense. Also, since there were new and emerging style markets, this was a great place to hopefully invest a little bit of money and let it grow big time, because if those companies grew to even close to as big as some of the ones in the United States, that's where you would profit a bunch. But since it was in foreign markets and their governments have different rules and do different things, the risk is very, very high compared to that of investing in the United States. So this portion of the portfolio is supposed to be something that will have a bit higher of risk, but hopefully that reward would be higher than that of the S&P 500. Many incorrectly believe that this portion is just there so that you are invested in something outside of the United States, and that somehow makes your portfolio more safe. They think that if like the United States drops a bunch, then the other parts of the world are going to go up or something. But what's that saying? If the United States sneezes, the rest of the world catches a cold. If we truly do have a bad period, the rest of the world is likely feeling it as well. But even more importantly, business just isn't done this same way. This strategy was built out in the 70s and 80s when things were totally different. In order to gain market share in Germany or China or Europe, one needed to actually physically set up shop in those areas. So it made sense to invest in a particular geographic location back then. Nowadays, after the invention of the internet and the optimization of logistics, literally all companies are global. I have students buying and selling from Asia while sitting in one of my lectures. I just had a financial coaching session with somebody in Dubai, so I technically took market share from Dubai, but sitting here in the United States. Apple's taking market share from every country in the world. Starbucks is selling coffee to people on all corners of the planet. You don't need to invest in specific international-only companies in order to get exposure of the international market. It's estimated that over 30% of the revenue received from the S&P 500 is from international exposure. The fact of the matter is that international ETFs just underperform. VXUS is one of the most famous and most invested in ETFs for international exposure. Over the past 10 years, the average appreciation per year is about 5%. That's weak sauce. You could get that type of growth sitting something in your high-yield savings account lately. So my new 3-fund portfolio takes the correct strategy from back in the day, but updates it with the correct funds for 2025. Number 1 is the same. I do agree that we should have a foundational broad US index, and this would be an ETF that tracks the S&P 500 like VOO, SPY, or SPLG. Or this should be an ETF that tracks the total US stock market index like VTI. Number 2 is where we start to change it up. This is the section all about providing safety, and it needs to be less volatile than something like the S&P 500 to provide you a little more safety and sustainability in the portfolio. Well, the old 3-fund portfolio has BND, or the bond ETF, for that. This thing has a 3-year average of losing you money at negative 2.36% per year, a 5-year of losing you money as well at negative 0.33% per year, and a 10-year of 1.33% appreciation. That's double weak sauce. With inflation, all of that is losing you money. So for this category, we want something that's going to be less volatile than the S&P 500, and bonds used to be that, but now they're almost as volatile as the S&P 500. The S&P 500 has a beta of 1, which basically measures the volatility and risk. We want something in this category much lower than 1. Looking at B&D, it actually has a beta of right under 1 or just right at 1, which is alarming. Instead of bonds, for most people that are still on that build mode, I would highly recommend that we get something that produces a good cash flow but still has high upside and is low volatility. We want something here that will do good when the rest of the market drops, and we want something low in technology, high in more sustainable things, but also does kind of good when the rest of the market is doing very well. For this, I want a dividend fund, and the best one in my mind in this category is schd, which is the Schwab US Dividend Equity ETF. Looking at that beta from before, it has a very solid 0.77 over the last 3 years, which is much more what I'd like to see here. Over the last 5 years, that bond fund, BND, is down almost 15%. And over the past 5 years, SCHD, the one that I suggest, is up over 40%. SCHD also gives out a nice little dividend of an average of about 3.5% and has been growing almost every year for a decade. So even in a bad year, of which if you look here, the worst year SCHD has had is down about 5%. So being down 5%, but then getting that dividend of 3.5% almost makes it a cheat code to where it'll grow when it's good, and you'll lose almost nothing when it's bad. This is the correct fund for that part of the portfolio. The third part of the portfolio is supposed to be a little bit higher of risk, but much higher upside, hopefully, than something like the S&P 500. Nowadays, the biggest moneymaker and the biggest firepower in the stock market is AI and technology. So we definitely want to take advantage of that sector, but overall, just all the growth and all the growing sectors. And there's a bunch of ETFs that could fit into this category, but I want this section to be very much dominated with a broad growth ETF rather than just those sector or specialty style ETFs. The broad growth ETFs I prefer are SCHG as in growth, QQQM, and VUG. These have a wide range of growth companies in different sectors and industries, which makes them a bit less risky than some that are only in one industry or sector. And those types of ETFs might be a technology one like VGT, or only AI semiconductor like SMH. So now to compare the old to the new, looking at VXUS, the 10-year average appreciation was under 5%. Looking at SCHG, the 10-year average appreciation is over 16.5%. If one put $500 per month into VXUS and received that 5% for 30 years, they'd have about $398,000. If one instead put $500 per month into SCHG and received 16.5% for 30 years, they'd be at $3,500,000. That is quite the difference. So the best 3-fund portfolio on the planet is one foundational ETF such as VOO or VTI, one safe and stable ETF that produces cash flow and a dividend like SCHD, and then one ETF for much higher reward but will be a little more risky. So that would be like QQQM, SCHG, or VUG. Now moving on to the age categories, and for all age groups that I'm going to be talking about in the rest of this video, I would be very comfortable with this style of portfolio. But I totally understand that it's nerve-wracking trying to do this all alone. I walk people through this all the time in my private financial coaching where we do about a 1-hour Zoom, and we can find the optimal portfolio for you based off your specific goals. I can also help you simplify your portfolio to make your life easier, and I'll only charge a flat fee rather than taking a percentage of your portfolio forever. Email me today at professorg.invest@gmail.com for private financial coaching. Like I've done in the past, I'm going to start this section with the oldest group and the age that's the highest, and then eventually go down to the youngest group. The most important thing here is, especially for those of you that are a bit younger, to see how everything switches as you get older. Because yes, we do pick types of funds that you could set and forget, but you kind of want to switch up at least the balance and percentage of how much of each in each fund as you get through different life stages. So first, let me start with retirement age. And now, if you notice, I just said retirement age and not an actual age. Because technically, if you're 35 years old and you have enough money stashed up and you're able to live off of that for the rest of your life and you're going to be very comfortable with that, then technically you're retired. In this stage, you're living solely off of your investments and then maybe some Social Security and other things like that, but you're not working to bring in an extra income. You definitely need to be invested much differently than those people that do have the reliance or safety of an income coming in case of a bad market downturn or something like that. Now, the common misconception that I hear for people that are about to retire or going to retire and are building up their large nest egg is that once you hit retirement, then you're done. You're done investing, and at that point, you just pull your money out and you live off of that money. This is incorrect. Because let's say you have $1 million saved up and you only need $40,000 to live off of, you wouldn't need to take out the full $1 million. You could just take out $40,000 and let the rest of that $960,000 continue to work for you in the market and hopefully keep growing forever. You do need to be smart and make sure and not have the bulk of that money in a risky situation where you could lose that money, especially when you're relying on it. But I just wanted to point out that you'll still be investing at least a portion of that. It doesn't just end. So the first concern for people in this life stage is safety overall. You can't control what's going to happen in the stock market, but you can control how you can be prepared for it. If we look at the market cycles, a typical market downturn lasts 1 to 2 years. During that time, you wouldn't want to be taking money out of the stock market that you have invested in there, because then you'll be taking it out at a loss. So you'd want to draw from a different place during that time so that we let it get back to normal. So what I tell my clients all the time is I'd like to see 3 years worth of living expenses in a high yield savings account or a CD or money markets just outside of the stock market. Now remember, if you're at traditional retirement age of over 65, you're likely getting some type of Social Security, maybe even pensions and things like that. So when I say living expenses, I want you to calculate everything. So for example, if you need about $5,000 per month to live for medical insurance, groceries, bills, and all that, but then you receive Social Security of $1,500 per month, then your actual expenses you need covered is $3,500 per month. So per year, that would be about $42,000. So for you, I'd hope you'd have around $120,000 in a high yield savings account or CD. It just sits there, gains interest, never really gets touched, and hopefully you don't need to use it. Since market downturns have rarely ever lasted a full 3 years, that'll give you optimal amount of time for you to weather that storm in the stock market, let your investments come back to life, and you will be very safe in that regard. This is going to make it so that you can be aggressive still and make it so that your money will grow when the market's good, but then also not have to take it out when the market's bad. And you can just wait it out and live off of that cash that you've set off to the side. In this stage of life, I'd set up my portfolio as such: 50% in a dividend ETF, 40% in a foundational ETF, and 10% in a growth ETF, with 3 years worth of cash in the high yield savings account. If there ever is a crazy market downturn that lasts 2 years or something like that, and you have to actually deplete that cash that was off to the side, then over the next couple of years when the market comes roaring back, instead of only pulling out the $42,000 you need for that year, you'd pull out double and start replenishing that savings account for the next possible downturn in a decade or so. The S&P 500 made about a 25% gain last year alone in 1 year. If you have $900,000 in and the portfolio makes just a 15% gain, that would be a profit of $135,000. So even if you take out what you need for that year, plus taking out that double, so another $42,000 to replenish back up that savings account, you're still going to be up overall $50,000 more. Now I know that I just mercilessly bashed those bonds down into the ground from before, but there still is a reason to include them at this life stage in my opinion. For those that just want to be extra conservative and not only have that 3 years worth in the high yield savings account, but also just hold another portion outside of the stock market just because, that would make sense to have bonds in this place for these type of people specifically only right here. A lot of my clients in this life stage feel at least a little bit at ease holding 10 or 20% of the portfolio in bonds at this point. So if you know that's going to help you sleep at night, then go for it. For one who wants to be a bit more conservative in this life stage, that portfolio would be 45% in a dividend ETF, 30% in a foundational ETF, and 5% in a growth ETF, 20% in bonds, and then 3 years worth of cash in the high yield savings account. The next age group would be 5 years from retirement. In my old video that I did a couple years ago, I jumped directly from the retirement stage to 10 years before retirement, but since I've been doing a lot more of these coaching calls and talking to people that are 10 years away and 5 years away, it's definitely a need to switch this up just a little bit, and it's very important to look at what retirement's going to look like when you're 5 years out. The main difference is in starting to set up that cash account that we were talking about and being very, very serious about building that up within this time period. You're still a ways away from actually retiring, so we don't want to take your foot off the pedal as far as building in that stock market, but we do definitely want to get that cash reserve built up. At this stage, I hope that you have at least 1 year's worth of living expenses saved up. Now, you're not on Social Security right now, and so I want you to have 1 year's worth of your actual living expenses, however much it costs for you and your family to live and be comfortable for the month, multiply that by 12 and have that much saved up in a high yield savings account off to the side. Your goal though should be in trying to figure out what your living expenses might be when you actually do hit retirement age, including the Social Security and other things that are going to be coming in. What do you think those expenses might be, and start getting to a point where you're building up to that 3 years worth so that you're ready to actually retire. As far as in the investing portfolio, I'd go 40% in the dividend ETF, 40% in the foundational ETF, and then 20% in the growth ETF. So now if you're 10 years away from retirement, you're likely 50 to 60 years old. 10 years is moderately close to retirement, but it's not too close. So I don't want you going too conservative on me here. You have a full bull cycle likely to go through, and I want you to get every single piece of profit of that. For this age group, my portfolio would be 40% dividend ETF, 30% foundational ETF, 30% growth ETF, with 1 year's worth of living expenses in the high yield savings account. The time to really start planning for that retirement is right about here at that 10-year mark. And so this is a lot of the time the types of people that I work with for my private financial coaching clients. What I've just explained up until this point is a pretty simplified and general concept for generally most people to be investing. But each person is different, each goals are different, and your specifics are what matter for your portfolio. You need to take this seriously so you'll be on track to retire. So email me right now so we can tailor everything to your specific goals and set up a private financial coaching call. So now if you're 20 years away from retirement, you're likely 40 to 45 years old, and you're in the prime of your earning potential for your career. You have a lot of time until your retirement, so you can weather any storm, but you definitely want to be smart here and take advantage of all the ups and not drop too low on any of the downs. You're also probably making a pretty good income at this point, and so you want to be careful in your taxable investing accounts to not have too much dividends in those types, because that tax that you're going to be paying during that time isn't going to be favorable for what you're trying to do. So we're going to try to keep your dividend investing just a little bit lower, unless your overall strategy is to get to a fully dividend portfolio. For this reason, we would want to bring down the amount in the dividend ETF to 30%, and then split the foundational ETF and growth ETF sections at 35% apiece. You'd want to have at least 6 months of living expenses in a high yield savings account for an emergency fund. Now for those of you that are about age 30 to 45, you have a bunch of breathing room here. But do not make the mistake of thinking that you can just YOLO into the newest meme coin or crazy GameStop stock and hopefully you're going to make it rich, but most of the time, 99% of these types of people just lose everything. And if you lose everything, now you're starting over with nothing. You still want to be smart, and so with a bulk of your portfolio, it should be the 3 ETF portfolio. You could possibly add in just a portion of that portfolio into riskier bets with higher upside, but just know that if you lose it, at least you're only going to lose like 10% of your portfolio rather than like 50 or 100%. I'd still encourage 90% in the 3 ETF portfolio, so I'd go 30% dividend ETF, 30% foundational, 30% growth, and then 10% allocated however you see fit by doing your research and finding good investments. But this could be individual company stocks like Nvidia or Apple, and then this could also be crypto like Bitcoin and Ethereum. Just be safe and disciplined to keep this portion of the portfolio small. I'd like it to be 10%, and for those of you that just need to go crazy, go 20%, but please don't go higher than that. For those of you just starting out, no matter what your age is, whether you're 18 or 80, I would highly recommend that you start out with the bulk of your portfolio, if not all of your portfolio, in the 3 ETFs. Do that for 1 year and just watch how the market moves and watch how simple it makes your investing. For me, it worked out best to keep it incredibly simple, and I just went 33% in each to give me a simple, balanced portfolio, and that did exceptionally well for me. After you have a couple years under your belt, you could change it up how you see fit and based on your life stage and life goals to be able to build the portfolio that suits you. Watch either of these videos next to keep you going strong in your investment journey. Remember to keep investing simplified and email me if you'd like to set up that private financial coaching.